Welcome to the Daily Update. We'll go over the action in the market for Tuesday, October 14th, and we'll see how things look for Wednesday, October 15th. Well, it looked like we were going to get a bit more of a bounce as we had that big down day last Friday. We lost 2.71%. We got about half of that back on Monday, but we were still looking negative. The indicators just weren't switching back to positive. Looked like, okay, even though the futures were weaker when we opened, some news came out that is putting this whole U.S. China trade war thing, it's scaring the markets a little bit. But the buy the dippers came in and tried to push prices up. Unfortunately, we saw some late day selling and we ended up closing just a little bit lower, virtually unchanged. And we're seeing some shifting around a little more out of the stock market into the bond market, which is pushing interest rates down, more of a flight to safety. That's typically taken as something more negative. But we're right in between two pretty important levels right now. We're below the 20-day moving averages, but we're above the 50-day moving averages. So nothing's really been decided on that front, at least yet. Okay, so right at the open, we had a gap lower open below S2, 6,600. It's kind of interesting. We had a pivot point line up with a round number that has now developed into a technical level. So we've dealt with this area before, but we found support at the 6560 level. That was down around the 50-day moving averages before rebounding back above S2, S1 at 6627. So we got back above 6600. We got above the daily pivot at 6648. Even then went positive above the unchanged level, but then we hit resistance at 6675. Then prices couldn't get above that R1 level, which is around the 20 period moving averages, and we drifted sideways with some late day selling. We ended up going down below the unchanged level and the daily pivot to close negative, but we weren't down all that much. 0.16% on below average volume. We did see volume drop off there. So we're still negative in the short term. We're hanging on to being positive, but seeing some weakness in the intermediate term. We're still positive in the long term. And as I mentioned, interest rates are coming down. We're not really sure where inflation's at these days because of the government shutdown. We're not getting any reports. And of course, all the geopolitical things going on, specifically in the Middle East and all the talks and everything that are happening there, but not really having an impact on the market. So some comments. The futures, they fell sharply after it was reported. This is while the market was closed. It was reported that China sanctioned 5 U.S. linked subsidiaries of South Korea's Hanwha Ocean. All right, it's not an ocean I've ever visited. Reversing yesterday's optimism sparked by Trump saying, everything's okay with China. And the 20 period simple moving average is now, it's continuing to act as overhead resistance. And then banks, that was kind of the big thing that happened in Tuesday's session. We had a lot of the big name banks, and they ended up closing mixed. Wells Fargo, they all had good reports, but Wells Fargo was up 7.15%. Citigroup up pretty solid. Goldman Sachs ended up being lower, as was JP Morgan Chase. So mega caps, tech, and discretionary underperformed. We are seeing a little bit of an improvement with the small caps, and mid caps actually had a good day. Now, there's a chart that I'll show later on that says, oh, maybe small caps are breaking out. I would hold on to that. We watch those charts pretty closely, and yeah, they're showing some improvement, but I wouldn't necessarily go over into the positive camp. But I'll show you a number of different charts, and then you can decide if that's an area that you are involved in. I don't do that. I just look at small caps and mid caps to see, okay, how are they doing in relation to the S&P 500? So then we did have some Fed speak. Jerome Powell gave a speech and he said downside risks to the job market have risen. Okay, well, we've been seeing some weaker than expected economic data coming out that applies to the employment situation, but we're not really getting anything. We don't have the latest employment report. And now that's going to be considered very old news. We might even get the next one if the government opens back up before we get the one we've been missing now. And then Boston Fed President Susan Collins said modest rate cuts are warranted as inflation eases while hiring has weakened. So again, a little bit of the attitude of let's just tweak the economy. Inflation seems to be under control. Employment's seeing a little bit of weakness. So if we come in and cut rates, that might help things. And we're still dealing with the VIX. Now, we went above 20 last Friday when we had that big down day. Then on Monday, we bounced. We got back below 20. Well, now we're back above 20. We're at 20.81 with the VIX. And that's the dividing line that I use because when we're below 20, we see positive annualized returns. When we get above 20, that's when we see negative annualized returns. So no changes here other than the Fed speak that came out that the market's pretty much locked into the idea that the Fed's going to cut rates later in October and probably again in December. The dollar was down. That helped stocks there. Interest rates were down. But again, this is more of a flight to safety. We're all the way down to 4.02% with the 10-year yield. And that's that level. If you watch the weekend video that I do, this outfit called RenMac, they did research a few years back that says when the 10-year yield is above 4.02%, that's when it starts to bite into corporate profits and earnings because they're having to pay more in interest. When we drop below that level, that actually helps companies' earnings grow more. So this is kind of an important level that we keep an eye on, where it was at 4.05% before. So we are seeing this flight to safety, getting out of the stock market, going into the bond market. Sentiment, we're still negative. We ticked down, even though we closed a little bit lower, but we spent a lot of the day in positive territory. But sentiment is still dropping off here. We're coming in at 30, where we had been at 33. We're negative with our trend. The red line's still above the green line. It's still a weakening trend since we're dropping below the moving averages on the short-term chart and the intermediate-term chart. But we're still above 20, so it's still considered to be a trend. And I put the bias at mixed, even though we closed slightly down because we were looking more positive during the day. We gave some of that up, but it didn't see an awful lot of conviction. Yeah, it was late day selling that took us down negative, but it didn't last very long. And I'll show you that chart. And momentum, I'm also keeping that at mixed for right now. We did get an economic report. It's not really a market mover, but the NFIB small business optimism came in at 98.8. It's down from 100.8. And here is a chart of that. So seeing a little bit of a drop off. So since most folks are employed by small businesses, to see this go down a little bit is a bit of a concern there. Then Isabel Net, we get this every week. This is a composite of overbought, oversold. Even with the declines that we saw last Friday, we're still coming in above 90 right now, considering in a bigger picture sense that we, according to this chart, are still overbought at this point. And still positive with the equity positioning above zero. Not really much of a change there. And then household financial asset allocation, 52% of households in some way, shape, or form are involved in the stock market. That's why it's a big deal. And where we're seeing a little bit of a drop down here to 15% from gas and then debt, that would be bonds. The stock market is still the place where folks want to be. And then realized and consensus earnings per share growth. We've seen this before. This is showing the S&P 500. That's what we focus on the most. We're going out into the future. We're seeing growth in earnings, and that justifies prices going up. Then we break it down into the equal weight S&P, and that's also looking better going forward. The Nasdaq's actually coming down. Nasdaq 100 is coming down. They see a real big move up here. Now, a lot of this is going to be dependent upon interest rates coming down. So off into the future, mid caps and small caps, they anticipate it being better, but they've been anticipating this before and it didn't happen. And so they just bumped these forecasts further down the road into the future. And flows into metal funds. Of course, we've got gold breaking out, doing all that. So naturally, people are going to start jumping in and chase that, figuring that they're going to be left behind. And then it's been 6 months since at least a 3% S&P sell-off, an unusually long gap with the gap since the last 5% sell-off, also 6 months. This is all back to April when the market was just going in the toilet. Not yet as extreme relative to history. So if you look at this over here, we don't see these big sell-offs all that often, and it's been a while since we saw one. So that's why it took the market by surprise when we had that fairly significant decline last Friday. And this is something that we see all the time, and it never really seems to change. we're overvalued as far as the PE ratio here with the Nasdaq 100 up at 29. Then small caps again, I use the S&P 600 because that's an S&P index and it lines up with the S&P 500 and the S&P 400 where when you look at the S&P 600, we're fairly priced. Here coming in, excuse me, coming in around the 15, 16 level. Well, here they've got it up to 25 because it's not as it doesn't calculate as smoothly. That's why I also look at the S&P indexes as well, where we have the S&P itself still above 20 at 23, equal weight, more fairly priced, and then mid caps also fairly priced. But mid caps haven't really been doing all that much. And then precious metals soar, and something that you probably have heard about. Spot silver, that means the cash price right now. Spot gold, these are the cash prices, not futures prices, not looking down the road. That's where they're coming in at this point. And we've been tracking this all year with gold being the best performing asset. And now silver's been doing really well also. And then ownership in the market, this kind of confirms what we were seeing earlier. Just it breaks down the percentages of corporate ownership, or I should say stock ownership across the different sectors here or parts of the economy. And then Poly Market, if you know, it's a betting outfit. And this is possibly a little more realistic. I was watching this pretty heavy, not this market. There was a different one, I forget their name, but you can bet on who you think is going to win the presidential election and other different elections. You can bet on anything, sports, politics, and so forth. The probabilities at that time last spring when we were really going down were much higher according to the betting market. And then we started to come down and it's still fairly low when we look at it this way. And then oil supply and demand it says there's a huge oversupply that they're projecting in 2026 with 2 quarters when production it really exceeds demand. Now that could really bring oil prices down even if the agency is off, who did this report, directionally, it's clear that the global oil market, I have to move this, is heading towards a surplus. It requires lower prices and contango. All right, is that a dance? I don't know. But anyway, they're just project. Now this could change, and then geopolitical things could happen, and that can totally have an impact on the oil market. And then precious metal ETFs, a lot of money going into these areas because and call options and things like that, people are chasing this now. And it's like, oh my gosh, gold was not really doing much there for a long time, and now it is. I better jump in. I have a fear that I'll miss out on that. And this is silver RSI. Now, I showed yesterday how we're hitting an overbought condition with gold. This chart is also showing us how we're really in an overbought condition with silver. Equity futures positioning here, and the green line, this is the S&P 500 here. But what they're trying to bring out here is that the Russell, those are the small caps. It's the main outlier when it comes to positioning among asset managers because we see these little spurts up in the small caps and everybody gets kind of excited about it. And then they either give back those gains or they chop along sideways. So that's why that's kind of the most non-crowded part of the market currently. And then this, I have some other charts to kind of compare you with this. They're trying to make something out of this, and I don't necessarily agree with it, but I want you to be able to make your own decision by showing you some different charts that are showing pretty much the same thing. This is considered to be very positive. When you have this long swoop down here, it's like a long-term low, and that could be what's happening. And it says small caps today are hitting the highest levels since a long time ago relative to large caps. So if you look at this, it's like, woo, hey man, maybe it's time to get into small caps. Well, look at this next chart because I also have this. The IWM, that's the Russell 2000 ETF, and then IWB, that's the Russell 1000. Those are the large caps, and that would be kind of equal to the S&P 500. This is that same chart that we just saw, IWM to IWB. And okay, we're seeing a golden cross here with this ratio, and it is improving. But see, this is longer term. I wanted to drag this out a little bit further to give you a little bit better of a look at it. So yeah, we are seeing some improvement here. And then we also do a small cap to S&P ratio. This is still showing how small caps are underperforming. And then another one, large cap to small cap. This is also, but the symbols are a little bit different here. So they're calculated in a bit of a different way, where we're looking at the Russell 1000 to 2000 ratio. And when this is going down, that means the small caps are outperforming. But we've been chopping around quite a bit lately. But if this ratio keeps going down, that means that the small caps are starting to outperform. So if that's your thing, if look at a lot of different charts, look at long-term charts, short-term charts, look at different ETFs, look at different indexes to try to get some kind of a consensus, because you can look at just one chart and try to make a decision based on that. And but if you had looked at a little different chart, you might reach a different conclusion. All right, so here's the chart here. We gapped lower. It looked like, oh boy, here we go. But you notice we didn't break below the low from Friday, which is just a little bit above the 50-day moving average. So we're still counting that as support because it's still below current price. But then after we had the lower open, man, we saw the buy the dippers just come in with a vengeance, and they were actually able to drive this thing back up, get us up into positive territory. But then we stalled out at R1 and then a drift down going into the close just a little bit below the daily pivot. And we're up just a little bit, but not much of a change in the initial overnight session. So we can see down here how the futures were negative, and then we tried to bounce back up, but then some weakness coming in as we were getting into the close. So not much of a change overall here. We have been coming down with the large cap growth to value intraday chart. We're trying to also get a bigger perspective here. Going back to the beginning of August, where we've been seeing this coming up, we were leveling off here, and now we're coming down. So it's not showing an awful lot of weakness, but it's not showing an awful lot of improvement either. And kind of getting to the lower end of the range now with the S&P intraday growth to value ratio chart. So growth was down where value was up. So it wasn't a good day for growth for the large caps. And we were up half as much for the mid caps, and but up a little bit more with the small caps. So still looking all right, but we did come down with the small cap growth to value ratio, but we're above the moving averages. So we'll see if that, and we've been seeing this even as we were coming up out of the April lows. We're just not seeing consistent breakout price action here when we look at the small caps. And here's the mid caps, which pretty much have been doing nothing as far as the index, but this is probably one of the stronger looking growth to value ratios that we're seeing right now, since both are above the moving average, or the lines, the ratio is above both of the moving averages. And still hanging around here at the 50-day moving average with S&P growth to value. Trying to come back up, but just a little bit under the 50-day moving average when we look at discretionary to staples with that ratio. And coming down a little bit more into the rainbow here with this growth to value ratio. So as far as our trend, trying to turn up here, but we haven't quite crossed above the moving average yet. We're negative because the red line is above the green line. Also kind of still below the moving average in the intermediate term, but also negative with the red line above the green line. And we were below average with volume here, but a little bit of a pickup from what we saw on Monday. To see the bounce that we saw on Monday on a decrease in volume, it doesn't give you a lot of confidence. We're still below average with volume, but we saw more volume on Tuesday than what we saw on Monday. And then here is the look at the gamma, where now it's looking like, okay, there's a positive side over here on the right. If we go up, according to the gamma exposure, these are the option Greeks, we're seeing some fairly significant resistance, overhead resistance at 6,700, and we're at the 6644. So I mean, a good, nice, solid up move. We could get to that level. Then if we drop down from here, now that's called the gamma flip, where we go from positive to negative, which would be at the 6841 level. And coming down, we do have some here at 6625. And I look for where the columns meet up with the blue line here. We also have some more support at 6,600. We're seeing a big pickup in these. When I showed this chart yesterday, we weren't seeing as much in the way of gamma exposure as what we're seeing right now. So this can be just a little tool that we use to find support and resistance. We're back above 20 with the VIX here, and this has been updated now where we're seeing a general move up in the VIX where it just was going sideways. Seasonally, we tend to see the VIX going up, but the decline in August and September and early October just wasn't happening. it didn't really kick into any kind of gear here until last Friday. And we don't know if that's just a short-term event and then the market will resume going up, or if it's the beginning of a more substantial downtrend. And we're still seeing pretty high volatility here with the VIX of the VIX, the bar chart, and the line chart, well above the moving average. And longer term, when we look at the VIX, the 3 month average of the VIX and do a ratio, this is still continuing to go up, where that's a little longer term negative, where we had been declining with this overall ratio as the S&P was going up. And also, now that the bond market was open again on Tuesday, we're still seeing this red line going up, where for a lot of the bounce up from April, we've been seeing this red line going down. And this is continuing to go up as well. So there's some fear coming back in to the markets. And also turning back up here, when we look at the VIX to VVIX ratio, this was declining as stocks were going up. Now we're starting to see this turn up, but this is longer term, and this is a 50 period moving average. It's pretty slow measuring what's happening in this middle chart. We did decline with this fear gauge, and we declined with this other fear gauge. So the VIX went up, but these other fear gauges that we follow actually declined. And we're getting a little bit of a concern here. The spread between risky and not as risky bonds, when this is falling, that means there's more fear coming into the market, the bond market. So just want to keep an eye on that. And when this was really going down before is also when stocks were really going down. So we want to see if this is going to continue to go down. So this is another thing we're watching here. And we did see a drop off with the equity put call ratio daily chart, and we're ticking down, but still above this red line. Generally, when we're going up, that's considered to be negative with the 5 day chart. And this is a longer term look where we got to a pretty low reading here, which sometimes can mark a market top overall, but we have to watch it play out to give it a little bit more context here. And we're actually declining a little bit now with the 10 day chart. So we're declining a little bit, but we were getting a very low reading here with the 10 day chart, which again, quite often, if you match up when we had low readings and then what happened after that, down here, this is right before we saw the big plunge last spring, and we were getting another low reading. Didn't see much of a reaction there, but we did end up going sideways for a while. So just want to keep an eye on this here. And coming down a little bit into the band with volatility risk premium. And we were seeing this really going up before we saw Friday's downward move. And then when we declined, that bumped this down. And then we started to go up on Monday. So this was starting to go up again. And now it's been dropping off. That's why we look at a lot of different sentiment gauges. Just the VIX in and of itself, we might not be seeing things in the VIX, but we might be seeing it in other sentiment uh, measurements that we look at. All right, so a little bit of an improvement here, bigger term or longer term, still positive with the advanced decline line based on price and volume. We are crossing back above zero with the short and intermediate term advanced decline ratio, and improving but still below zero with the advanced decline oscillator. Still going down with the 5 day and 10 day chart. We did see a nice little bump up here in the new highs and a contraction of the new lows, but we're going to have to see more of that to turn these moving averages back up. And not much of an improvement here with accumulation distribution. Longer term, we're positive, but we bounced up but didn't get back above the moving average after Monday. We're still below the moving average here, shorter term after Tuesday. And we are starting to turn back up ever so slightly with the Chaikin money flow. And we are turning up, but we're still negative since we're below the moving average with the Chaikin oscillator. So our smart money indicators are showing some improvement, but they haven't turned over to positive. And we're negative here with the vortex. The red line is above the green line. And we're trying to get back above the moving average with the S&P with the advanced decline line here, improving with all of the indexes, but the other ones, the NYSE common stock, mid caps, and small caps, they are still below the moving average. Improving, but still below zero with those stocks above their 20-day moving averages inside the S&P, right at 50 now. That's equilibrium with the 50-period moving average study. And we came back above 50 with the 100-period moving average study and bounced up with the 200 moving average study. So we're still counting this as support here. We came just about down to the 50-period moving average, and we didn't break below that. We saw some buying coming up off of that. So that's acting as support. And then later on, I'll show you the 20-period moving averages, which are continuing to act as resistance. And we were below average with volume. So a bit of an improvement, but still below 50 with the 20 moving average steady, slightly above 50 with the 50, and bouncing back up above 50 here with the 200 period moving average steady, and still in the lower area here with the Stoke RSI, also in the lower area with the Williams percent R, lower area with the CCI 14 and 20. So we're not seeing any real conviction right now, either positive or negative with our short-term indicators. Nothing here. One of the few times we don't have stochastics on the list. Right about at the midpoint with the short-term stochastic, declining below the midpoint in the intermediate term, and dropping after being extreme for quite a while with the long short-term stochastic, and still below zero with the force index. Still seeing some vulnerability to the short-term trend. Based on 20 periods, the lines are now starting to roll over. And this is acting as overhead resistance. The simple and exponential moving averages based on 20 periods, we cannot seem to get back above them. If we do recapture that, then that'll be more positive. But on the other hand, notice how when we came up out of those April lows, this acted as support. And the times that we did fall below it, it only lasted like for one day. We fell down and came back. We fell down and then came back. We fell down, we came back. This is now the third trading day that we've spent pretty much below the 20 period moving averages. I'm taking that as a little bit more negative, but until we come down and actually break through the 50-day moving averages, this is still, we're not shifting over and looking more negative, at least yet. And then we have the 10-day simple moving average here. We can't seem to get back up to that. We're right about at the 20, which is acting as resistance, and we're falling a little bit we're closing a little bit above the 30 period moving average. And right at the midpoint with the standard deviations chart, we saw a bit of an improvement here with the balance of power. We're above zero, so that's leaning more positive, but we're leaning more negative with the go, no go. With the lighter blue bars, we're right about at the midpoint with the highest high, lowest low value chart. But according to Landry Light, we started an uptrend at the beginning of May, and we're still in that uptrend for the 115th trading day. Also, still in an uptrend, 109 days now with the proper order uptrend. But we're continuing to go down with the TTM squeeze. This has been dropping off here with the darker blue, and we haven't quite crossed below zero yet, but this is negative. Still below zero with the ease of movement. We haven't been able to cross back above zero. Dropping down a little bit, but still looking positive with the Arun. And barely positive with the S&P McClellan oscillator. We just barely came back above zero. So now you can't see it here, but we're barely ticking up with the summation index based on price. However, we're still declining with the summation index based on volume. And we're improving with the NYSE McClellan oscillator, but we're still below zero. So when that's below zero, we're continuing to decline with the summation index based on price and volume. And actually turning positive here. The swirling trading oscillator is turning up based on price and volume. But momentum is still drifting down here. We're going down with the PMO, we're drifting down based on price, and we're below the moving average and turning more negative based on volume. But we did see another improvement here with the PMOs that are rising, but we're still below 50. Trying to turn back up, but below 50 with the buy signals, and trying to turn up here with the PMOs that are above zero, and it's still above 50. But we're still negative with the Elder's Impulse system for the S&P, still negative with the parabolic SAR. Short-term slope oscillator continues to be negative. The MACD continues to be negative, and we're drifting down here pretty much on all the time frames, short, intermediate, and long-term with the momentum oscillators, and we're also negative with the Copic curve. Coming down, but not really getting down into the sickly looking yellow area or tan area here. But we did decline with the Sean trend meter. We're still above 50 with the money flow. We're still just a little bit below 50 with the ultimate oscillator. We're still above the moving average with on balance volume, and we're continuing to decline with the bullish percent index. That we've been trying to bounce up here, and this is continuing to go down, and that's showing some weakness developing inside of the S&P. And we ticked up just a little bit, and we're above 50 with the NYSE bullish percent index, but we're declining right to 50 with the NASDAQ 100 bullish percent index. We're just barely above 50 with the intermediate term RSI. We're barely below 50 with the short term RSI. And starting to spend some time down here below these lines with the 50 period moving average study here. And that's causing the red line and the blue line to at least flatten out, if not start to decline. And this is what we're watching. 50 period moving averages. So far, we've been able to hold out above these levels. And this orange line here, which is an anchored weighted moving average, we haven't broken below that. That's another support level that we're watching. So we're below the 20s, but above the 50s here. So we're kind of just bouncing around in no man's land until we get some kind of a catalyst that's either going to take things down below the 50-day moving average or bring things back above the 20 period moving averages. And the praying bottom fisher, that's almost ready to go away here, but it's still above the red line, so that's still considered to be a buy signal. All right, and we're kind of just chopping around inside the mini rainbow here with the 20 period simple moving average of the open, high, low, close. And still looking okay here on the weekly chart. So far, we're up 1.4% on the week. And if we really start to go down, we'll be watching this R1 pivot point at 64.68. So leaning more negative from a trend perspective here with the Heiken Ashi. We're negative since we're red, but we're pointing up with the Kegi chart. And we're looking negative with the Renko chart as well as the three-line break chart. Longer term, seeing a bit of an improvement here with the 150 and 200 moving average steady. So now we're back to positive. I don't know if I agree with all of this. This is stockcharts.com and they have their own way of calculating this, but we were all negative even after Monday's advance, and then we have a little bit of a down day and these switch to positive. Okay. Not sure about that one there. Still negative in the short term with commodities, and this could pressure stocks if we see the dollar in a short and intermediate term uptrend, because it's the dollar that's been going down that really helped stocks come out of the lows from April. And then we had energy and tech. They ended up being down. Staples, that's defensive. And that was one of the stronger areas. We also had industrials. Now the banks reported, so that had an impact on the financial sector as well. And then communication was up 0.2% there. So started off with negative things since we had the lower open. In Canada, after their Thanksgiving, they came back feeling a little bit happy. But a lot of things negative, and then it started to turn a little more positive as the day unfolded here, with various indexes crossing above and below specific levels. But seeing the industrials have a BPI below 50, healthcare, bearish MACD crossover, that's defensive. Staples having a BPI cross above 30 because they've been getting hammered pretty hard lately, and now they're starting to go back up, and that could be more defensive, which is more negative for the market. But then once it crossed above, then we had Staples cross back below. So it's like, make up your mind. And then real estate BPI crossed back above 50. The Dow got back above 46,000. And then tech had a BPI cross down below 50. All right, and then a lot of the big red areas, that's why the market was dragging here. Amazon, Tesla, that hurt discretionary. We had Nvidia down, Microsoft down a little bit, Apple up a little bit, but Oracle was also down as well. And when you see a lot of the big boxes that are red, that's more negative. And then more of the defensive areas, we see more green down in this area. So the Dow is been able to get back above this pivot point, but and so far its 50 period moving average is still providing support. We've gone from negative to positive with the diamonds. With the Elder's Impulse system, we're still holding out above this pivot point now with the Nasdaq 100. That's another area that we're watching. Excuse me, the Nasdaq. If we break down below this and then we possibly break below the 50-day moving average, that's going to turn the Nasdaq more negative. And we're negative after being neutral with the NASDAQ, looking at the Elder's Impulse system, still holding out above this pivot point with the NASDAQ 100, and we're negative with the Qs, looking at the Elder's Impulse system, negative with the momentum for the NASDAQ 100, still a little bit below the 20 period moving average here with the triple Qs. Small caps, they were up 1.5% here, just a little bit below this pivot point. They were able to get back above their 50-day moving average. And we were up just a little under 0.5% here with the Russell 2000 small caps. And still net positive with the small caps with the Elder's Impulse system. We were able to get back above the 50-day moving average with the mid caps, and we're also positive with the Elder's Impulse system. The 50 period moving average is still holding up as support for the Wilshire 5000 and the total U.S. stock ETF. And we're still below the 50-day moving average, even though the financial sector was up over 1%. And this ratio is showing how the financials are underperforming the S&P 500. So then we look at the FinTech Innovation ETF, ARC-F. Okay, we're still above the 50-day moving average when we look at the ETF by itself, and we're just a little bit under the 50-day moving average when we do a ratio with the S&P. So this is holding up a little bit better than the financial sector to the S&P. And banks were able to get back above their 50-day moving average. We've been seeing some weakness there. We had some earnings reports came out, and that gave a over 3% boost to the bank ETF. The FANG index also still above the 50-day moving average. And so Apple was virtually unchanged. We had Amazon down just a little bit above its 200-day moving average. Microsoft is still hanging around its 50-day moving average. Google was up a little over 0.5%. Meta right in between its 50 and 200-day moving average, down almost 1%. Nvidia coming back down, it dropped 4.4%. It got hit by the news coming out of China, or the fears coming out of China, but it's still above its 50-day moving average. And then Tesla was down 1.5%, but still above both of the moving averages. And Netflix just hanging out around its 50-day moving average. And seeing a bit of a drop off here between US and world stocks in the short term correlation, still seeing fairly strong here with the longer term correlation. And dropping down with oil, we're getting more into the 58 range again. Yeah, we want to keep an eye on this. This is the gold to S&P ratio. Gold has become very overbought. Silver's been very overbought. A lot of people are saying, gotta buy gold, gotta buy gold. That's usually when the frenzy at least cools down for a while. Well, we're getting very close. We had when we look at this ratio here, we had a top set in 2016, and then we set another top in 2020, and then the trend line is just connecting this. And earlier on in 2025, we came right up to this trend line and then went back down. We're getting very close to that again. So we'll be watching to see if this provides overhead resistance that might help gold start to see some profit taking. The dollar still not at the 100 level here, but it has been improving, even though longer term it's in a downtrend. And we're dropping down here. We're still above that 4% level with the 10-year yield, but that's again is seen more as a flight to safety, which is not necessarily a vote of confidence for the markets. And we are going up with the 10-year based on price. So we're still holding out above the moving average with the Qs to S&P growth to value ratio. We're improving, but below a declining moving average with discretionary to the S&P. And now we're dropping below the moving average when we compare large cap growth to value. So just a little bit below the moving average with the large caps, still a little bit above the moving average with the mid caps, declining but above an advancing moving average with the small caps. And then the Hindenburg-Omen here, this is a definition. You can read through this. I'm not going to go through this. The stock charts have they took all of these criteria over here and put it into one indicator that I look at right here. Now we had the initial spike, and that was registered on October 10th, which was last Friday. What we need to see is between now and November 7th, another spike. And that hasn't happened yet. So we're just waiting to see if that will happen there. That's a negative one. Now, a possible positive one is the ZWAG NYSE breadth thrust. We have a very low reading and we're coming up out of that. There's a 1 day lag with this chart too because it's the next business day. But between October 10th, which was Friday, and 10 trading days later, which is I think October 24th, I've got the date later on here. We need to get up to this red line. And that's a very positive sign if that ends up happening. So what's our outlook then? We're still negative in the short term. We're positive in the intermediate term. We're below resistance. We're above support for right now. Now, we're supposed to get the MBA Mortgage Applications Index. We get that every week. CPI doesn't look like that's coming out. And the Empire State Manufacturing, we'll see if we get that one because the government shutdown is continuing. And then all the geopolitical things going on that, very interesting. You got the baseball playoffs, very interesting on a personal level there, but the market's not really paying attention to those things currently. They're more focused on anything developing between the U.S. and China. So this is what's supposed to be happening, but we don't know how many of these reports are actually going to come out. This also is a calendar where, again, they bumped out the employment report to Friday, but this will be the third time they bumped that report forward. So seasonally, not much of an edge here for October 15th, but we are slightly neutral to positive. But we are in options expiration week, where we're up 73% of the time and down 27% of the time. And not really negative seasonality here, but nothing all that strong here. When you look at post-election years, I follow the green dashed line. And now this shows that we see a little bit of weakness coming into the end of October before we see positive seasonality going forward. And now we're starting to finish up with the first half of October, and we're going to be entering the second half of October. I'll switch this over when we hit the 16th. And we're still seeing a lot of blackouts now. Companies can't buy their own stock because they're getting ready to report earnings, or they can't announce buybacks either. So still a lot of companies, but it's starting to taper off, and it'll do that as we work our way through October. So when we look at our three smart money indicators, we're negative in the short term with the boom indicator. Longer term, we're positive. We have barely turned up with the red line with the Chaikin money flow. We've improved, but we haven't crossed above the moving average with the Chaikin oscillator. So that's still negative. And the ease of movement is still below zero. Parabolic SDR is negative. Ultimate oscillator and the NYSE McClellan oscillator and summation index did improve, but is still below zero. That's causing the summation index to decline. The momentum indicators are negative. And the bullish percent index continues to drop for the S&P. The vortex is negative, and the momentum for the Nasdaq 100 is negative. And November 7th with the Hindenburg Omen, we have to have that be confirmed by then. So we got a little bit of time to see if this is happening. But again, I don't have any direct evidence of this, but I've seen this happen before. That the perma bear folks out there, they count this as a done deal right now. They don't really wait for the confirmation. They already declare it to be done. Put a fork in it, the market's just going to tank. Where what we should be doing here is waiting to see if this confirmation actually happens. Then on the positive side, that we're still not seeing an awful lot of strength shorter term with our growth to value and discretionary to staples ratios. Longer term, they're still positive though. And then the S&P McClellan oscillator just barely above zero, so we're a little bit positive based on price. We're still going down based on volume. The swing and trading oscillator has turned up. That's positive now. And the Nasdaq 100 and NYSE, even we're right at 50 with the Nasdaq 100. We are declining, but we're still above 50 with the NYSE bullish percent index. That's why they're considered positive. The money flow is positive in the financial sector, but it's continuing to underperform the S&P there. The long-term daily and weekly special K charts are still positive, and we're just about ready to take this off the list. The Pring bottom fisher is just holding on to a weakening buy signal right now. And then by October 24th, we want to see if we're going to get a confirmation from the ZWAG NYSE breadth thrust. All right, and then here are the pivot points for Wednesday's session. So the conclusion is that we're negative in the short term, positive in intermediate and long term. We're below resistance, but we're above support. So we're just kind of bouncing around right now. The 20 period moving averages are acting as resistance, and we're below that. That's why we're negative in the short term. We're positive since we're above the 50 period moving averages in the intermediate term. And long term, we still continue to be positive. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.